Welcome back to the Deep Dive. Today, we're going to unpack the Q3 2025 results for Crane NXT Co. That's ticker CXT. They're the detection and authentication tech company.
Yeah, and this quarter was, well, a bit of a puzzle, wasn't it? You had really strong execution, clean beats on the numbers, but also this immediate confusion in the market.
Exactly. They beat estimates, showed strategic growth picking up speed, but then management offered some cautious near-term guidance, and that just, well, it seemed to sour the mood immediately.
So there's this disconnect. Why did a quarter that looked pretty good on paper lead to a stock sell-off? That's what we need to get into.
Right. Our mission today is to explore that strategic dissonance. We want to understand the longer-term plan. CXT is pushing this portfolio pivot and, figure out why the market got hung up on maybe some shorter-term issues.
Okay, let's start with the headline numbers then, because they really do show that operational strength. Adjusted EPS, it came in at $1.28.
And consensus was what? $1.25 and $1.26. So a decent beat there, maybe 2-3%.
Yeah, solid beat. And sales too. Net sales hit $445.1 million. That's up 10.3% year over year.
Which also cleared expectations.
Right.
The street was looking for maybe $430 to $433 million. So that's another beat, 3-4% surprise on revenue. Pretty good.
Very good. And importantly, cash flow was strong. Adjusted free cash flow was $85.3 million in the quarter. That works out to a conversion ratio of about 115%. So operationally, things look, quite healthy.
Driven mostly by acquisitions and some favorable currency moves, it sounds like.
That's a big part of it, yeah. But there's core strengths too, especially in one area.
Okay, so let's unpack where that strength is, because it wasn't across the board, was it? We really need to zoom in on the engine here.
Yeah.
The Security and Authentication Technologies segment, SAT, this seems to be where the real long-term story is unfolding.
Absolutely. SAT is clearly the growth driver right now. Sales in that segment just soared up 28.1% year over year.
Wow, 28%. Okay, how much of that was organic versus M&A?
So the breakdown was pretty clear. You had 8.8% core growth, which is really solid organic performance in itself. But then a massive 15.8% lift came from acquisitions, mainly the recent De La Rue deal.
Okay, De La Rue. And they're seeing strong demand, particularly internationally, for currency tech. What's the proof point there? Is it just talk, or is the backlog growing?
Oh, the evidence is pretty solid.
Yeah.
International currency demand is definitely fueling this. The backlog stands at $557 million. That's near a record high.
$557 million, okay.
Yeah, and that gives them visibility well into 2026. Plus, management pointed out that year to date, 9 new international denominations have specified Crane's micro-optics tech for their banknotes.
Right, the micro-optics. For listeners, that's basically their sort of proprietary anti-counterfeiting feature, hard to copy, locks in contracts.
That's exactly it. It's a very sophisticated security feature. And getting those design wins is why the SAT margins expanded so nicely, up 250 basis points year over year, hitting 24.4%. That tech edge gives them pricing power and makes those government contracts really sticky.
And then you've got the U.S. side lining up too, right? The Fed's 2026 print order looks favorable.
Yeah, that's another tailwind. The order favors higher denominations, think $10, $20, $50, and hundreds.
Right.
And all of those use the advanced features that CXT supplies.
So that mix shift alone should boost their U.S. business.
Correct. They're expecting that to drive high single-digit growth for the U.S. currency business in 2026. They're already ramping up for the new $10 note that's scheduled for mid-2026. And the design process for the new $50 bill, which is slated for 2028, it's actually already started.
So a nice multi-year cycle kicking off there. Okay, let's talk more about the M&A shaping this. The De La Rue integration, you said it's adding like 7 points of growth already in Q3.
Yeah, contributing significantly right out of the gate.
But part of the plan is pushing De La Rue's older holographic customers onto Crane's higher margin micro-optics, right? Is there a risk they lose some customers in that transition, or is the tech just that much better?
That's the bet they're making. Management seems confident that the superior security and the long-term nature of these government relationships mean they can manage that transition. They're actively prioritizing that margin upgrade.
And they have a target for that.
They do. They expect the overall authentication business, which includes the De La Rue piece, to exit next year, approaching a 20% operating profit margin. So they clearly believe the margin gain is worth any potential short-term friction.
Okay. And the M&A story doesn't stop there. There's the big one pending Antares Vision.
Right, the Antares Vision deal. That's a $445 million enterprise value transaction. This brings in track and trace technology, specifically for life sciences and food and beverage.
Track and trace. Just explain that quickly. Like serialization for drugs and high-value foods.
Essentially, yes. Using specialized digital markings, data capture, to follow a product through the supply chain. Think pharmaceuticals, medical devices, even some premium foods. It's about authenticity, safety, compliance.
And that aligns them with different growth drivers. Less about cash, more about regulation.
Exactly. Structurally higher growth markets, often driven by global regulations around supply chain security and anti-counterfeiting. It's a big strategic move.
It really is. I mean, think about the portfolio shift. If Antares closes, they're expecting first half of 2026. The company says its dependence on cash-related products drops from, 80% when they spun off down to maybe 60%?
Approximately 60%, yeah. That's a huge, rapid change. It's not a gradual pivot. It's, like you said, almost a surgical reshaping of their identity.
And does the market fully appreciate that yet? Based on the stock reaction, maybe not.
That seems to be the core issue, the dissonance we talked about. This shift into these faster-growing, regulation-driven, arguably more secular markets, that's probably the most important long-term takeaway. But the market seems focused elsewhere for now.
Okay, let's pivot to that elsewhere. The part of the business that dragged things down a bit. Crane Payment Innovations, or CPI. This is where the caution seems to stem from.
Right. CPI sales were down 3.8% year over year overall. If you look at the core sales, stripping out currency effects, it was down 4.5%.
And that weakness was mainly in certain pockets.
Yeah, concentrated in the shorter cycle end markets. Vending was the main one mentioned. Volumes there were down high single digits.
Why? Just customers delaying upgrades.
Seems like it. Management pointed to customers pushing out purchases, likely related to the price increases CXT had to pass through because of tariffs earlier. So classic cyclical pressure hitting that hardware side.
But even with volumes down, they managed the margins okay in CPI.
Remarkably well, actually. CPI maintained an adjusted operating margin of 31.1%. That's pretty impressive given the volume drop. Shows good cost control and pricing discipline. They didn't let the volume hit kill profitability.
Okay, and wasn't there a bright spot in CPI too? Something about the service business?
Yeah, that often gets overlooked. Their service business is actually expanding beyond just servicing their own cash equipment. They mentioned winning contracts for things like kiosk servicing, and that's driving mid-single-digit annual recurring revenue growth, ARR growth. So a nice recurring piece there.
All right, so let's tie this all together with the guidance change. We have SAT booming, CPI softening a bit. How did that translate to the full year outlook?
Okay, so management actually raised the sales growth guidance for the full year 2025. They bumped it up to plus 9% to plus 11%, up from plus 6% to plus 8% before. That reflects the SAT outperformance and the M&A contribution.
Oh, the earnings guidance.
Yes, the but.
Okay.
They narrowed the adjusted EPS guidance range. It's now $4 to $4.10. The previous range was $4 to $4.30. So they kept the bottom end but trimmed the top end by 20 cents.
And that narrowing, was it just because of CPI weakness or something else?
It seems like a mix. Definitely reflects caution around that CPI demand, especially in vending. But management also specifically called out higher operating expenses they're taking on right now to ramp up production capacity for the international currency side.
So investing for that SAT growth, spending money now to meet that huge backlog.
Exactly. They're choosing to incur some costs today to make sure they can deliver on that strong SAT demand and secure that long-term growth. It's an investment decision that pressures near-term EPS slightly.
Got it. And looking further out, what did they hint at for 2026?
Initial thoughts were mid-single-digit core growth continuing for SAT. So still strong there. But for CPI, the outlook was more muted, flat to maybe low single-digit growth overall. And specifically for vending, they expect it to remain flat next year due to those ongoing tariff and macro headwinds.
Okay, so that brings us right back to the main conflict, the investor context. CXT is executing this strategic shift, moving away from just cyclical hardware towards this diversified security and authentication company via M&A and these big currency programs.
But the market reaction zeroed in on the immediate stuff, the trimmed EPS guidance, the CPI softness, maybe the cost for capacity expansion, not the bigger picture structural upgrade that's happening under the hood.
And the stock price reflects that caution. It's lagged the industrial sector, lagged the S&P 500 over the past year.
Yeah, it hasn't really gotten credit for the transformation yet. So looking ahead, what should investors be watching for? Key catalysts.
Well, definitely updates on the Antares Vision closing. That's expected in the first half of 26. Any early talk about synergies there would be key.
Right. Also watching for any regulatory milestones, especially for the U.S. currency ramp-up, making sure those programs stay on track.
And then there's the Investor Day they mentioned, February 25th, 2026. You'd expect a much deeper dive into the strategy, the portfolio mix, the long-term vision then. They'll really need to sell that pivot.
Absolutely. That will be a big opportunity for them to frame the narrative.
So the strategy seems pretty clear, transforming the company. But the market's still skeptical, focused on the near term, which leads us perfectly into our next segment.
Ah, yes. This is not financial advice.
Right. Disclaimer out loud. This is where we speculate a bit, put on our slightly more aggressive analyst hats, and propose a trade idea based purely on the dynamics we've just discussed. Something plausible, maybe a bit out there, capitalizing on that dissonance.
Okay, I'm listening. What's the pitch?
The pitch today is basically a way to play that internal divergence. It's a synthetic position. Go long the SAT segment and short the CPI segment.
Interesting. Long the growth engine, short the cyclical drag. Explain the rationale.
Look, the company itself is voting with its capital, right? All the focus, the M&A dollars, the narrative. It's shifting aggressively towards SAT, the higher growth, higher margin, regulation-driven authentication and currency business. It's got the backlog, the tech edge, the M&A fuel. That part deserves a higher valuation.
While CPI, despite decent margin management, remains kind of stuck with those macroeconomic and tariff cycles, it caps the overall growth multiple the market is willing to pay.
Exactly. CPI is the anchor, relatively speaking. So the bet here is that the market will eventually have to re-rate CXT more as an authentication security company and less as just a payment hardware company.
So you're betting that the successful integration of De La Rue, the margin uplift there, plus getting Antares Vision closed and integrated, that this will make the value and growth profile of SAT so prominent that it forces a re-rating, even if CPI continues to just muddle along or slightly underperform.
Precisely. It's a bet that the portfolio mix improves and the quality of earnings improves faster than what's implied by that slightly trimmed near-term guidance. You're betting on the strategy outpacing the current market perception.
Got it. A bet on the pivot paying off sooner or more significantly than expected.
Okay, that pretty much wraps up our deep dive into the Crane NXT Q3 2025 earnings call. The big takeaway. Operationally, quite strong, especially in that SAT segment driven by currency demand and smart M&A. But the market got spooked by the CPI caution and the costs tied to future growth, leading to that muted reaction.
Yeah, a fascinating case study in market focus versus long-term strategy. And just to reiterate, while we've broken down the call, none of this constitutes investment advice. It's just our analysis of the information presented.
Absolutely. We hope this breakdown was useful. Thanks for tuning in to the deep dive, and we look forward to continuing the conversation next time.